in focus, and that's IT, and two companies that have reported their Q2 earnings, Wipro as well as HCL Tech. And what a divergent performance from both of them. Wipro was down close to about 5.5%. Q2 numbers were in line with street expectations, but what the street is disappointed with is the December quarter outlook. The company's Q3 revenue guidance at 0.5 to 2% has missed expectations. Also, deal wins have come down on a quarter-on-quarter basis. And finally, it's not that margins, which are at very low levels of just 15.1%, are going to see a runaway improvement. In Q3, the management has already guided that margins will be at similar levels compared to the current quarter. So it's not that there is a big margin recovery, and brokerages have brought down their EPS estimates for Wipro. We'll talk about HCL Technology as well, but let me invite the management of Wipro. I had a chat with them yesterday, and I began by asking the Wipro CEO, Thierry Delaporte, on why did they declare this modest guidance for the coming quarter.
First of all, the reality is that we've been growing, as you know, pretty strongly in the quarter two, 4.1% after and an acceleration after quarter one. If you look at the performance in bookings, very strong performance in bookings in quarter two, after a strong quarter in Q1. So actually, we have the volume of business to continue to grow in Q3. Now, what we factored in our guidance is also a certain reflection of the evolution of the market and the reality of the market. No one will question the fact that the market has changed from about a year ago. And in this context, comes the context of furloughs, right? There are furloughs. We know that it's typically the season of furloughs. And we will discuss, and we are discussing with our clients to see, what's possible and what are their expectations. But I think in a market condition where uncertainty exists, and I think it's true for most of the sectors across, Europe and America, we just felt the need to be cautiously optimistic, and that's the context of the guidance we have taken. You will see, maybe we've been slightly cautious, but that's where we felt we were right now, and we will continue to observe the evolution of the market. For now, the demand continue to be strong, and certainly, if we look at the volume of deals to close in Q3, we are also optimistic and positive about the fact that we can deliver another strong quarter in bookings.
Jatin, could you tell us what we should expect on the margin front in Q3 and Q4? Because at that time, there will be no residual impact of wage hikes. How much can you expand margins from the current levels of 15.1%? What could the exit margin rate look like?
So let me first start with what we shared last quarter. We said that for 2 to 3 quarters, we believe that we will be in this range. And, despite having made investment of a month of salary increases, plus the promotions that we gave from beginning of the quarter, happy to report we are at slightly higher than where we were in quarter one. Commentary remains the same for quarter three. We will have 2 months impact of salary increase, and we believe that we will remain at 15% or slightly above is the number that we shared in past, and we continue to see that. It's difficult to call right now for Q4. We don't guide, but clearly the endeavor in medium term is to continue to improve that trajectory and of margin. And this range of 15 that we have shared is for the 2-3 quarters that we spoke about in beginning of Q1.
Jatin, your medium-term margin aspiration is 17 to 17.5%. Given the gap between where you are currently and what your aspiration is, do you think this guidance will be difficult to achieve even in FY24? What, according to you, is the medium-term, not medium-term, but say next year's projection on margins?
Yeah, so Rima, it's a great question, but I would rather not hurry in answering it now. I think we have guided it clearly for Q3 and will execute on that. But we will come back at right time to talk about that margin aspiration.
Okay, so one more question then. X of the wage impact, are there any other cost pressures that you are seeing? X of compensation, wage hikes, is there pressure, say, on deals, on account of competition?
So Rima, really, wage pressure is the largest one, and in fact, I would say that if the attrition moderates, which is what we have spoken about in the earnings in the press conference and sort of spoke about it. In fact, it will reduce some of the pressures that we have seen or industry has seen over last 6 to 8 quarters, where we had to hire a lot, many more laterals at higher cost. So in fact, I would say some of those pressures which were existing in prior period are moderating.
Let me take that cue from the word hiring. Saurabh, this quarter's hiring number looks very low at just 600 versus more than 10,000 that you've been clocking in over the last couple of quarters. Is part of the reason, at least on account of the uncertainty, the changing reality of the market, as Thierry put it? I know part of it is because of the base and, you've hired a lot of people in the last few quarters, but is part of it anticipating weaker demand?
So Rima, as we had called out and Thierry had very clearly said in Q1 when we had spoken to you, we are investing ahead of time. And that's exactly what we had done, with a very clear clarity that as we invest and hire more freshers, we will take time to train them and make them ready. So that was the plan. So it's a very planned thing what has happened in Q2. We had invested ahead of time in Q1, and we have made sure we balance it out in Q2. And going forward, it will be a very conscious effort to make sure, depending on the business in an uncertain environment, whatever the requirement. Only thing I can say is that the supply side will not be a constraint in driving the growth agenda.